I will go through the yen for sure. All right, it looks like we're live on YouTube. Welcome. So welcome everybody. Welcome back, Chart Addicts. Welcome back everybody who's watching on YouTube. My name is Roy Dunya, co-founder, CEO of ChartAddicts, #1 personal coaching and education service in the world for traders. The purpose of this stream is to go through market updates, to go through news, and to go through anything that's happening in the macroeconomic landscape. So really, I want to make sure that you guys are all equipped with the information you need to take advantage of any market conditions that come up, especially right now with this huge shift going into kind of the digital space. We're in a massive transition period. We probably have a good 3 to 5 years where we're going to be shifting from the traditional legacy system over to some of these new digital systems. And there's going to be a lot of money transferring over in that time. So hopefully we can all look at the landscape, look at where we are in the overall cycle, and try to take advantage of opportunities depending on where we are. So make sure you guys have the info and that you guys can use the info to make some money. That's the real point of this stream. This stream is sponsored by Enigma FX. Enigma FX is a signals app for Forex traders. If you guys are interested in signals, you can head over to enigmafx.app and start a 30-day free trial if you guys sign up in the next 2 weeks. So Enigma, $97, but it's a 30-day free trial. You guys can try it out. All the results are posted, trade history is posted, and Enigma is sponsoring this stream. So what are we going to do on this call? Macro updates, meaning big picture, recession watch, key metrics to look for in terms of the recession, and then things to look out for just in terms of opportunities and money-making opportunities. So big picture. Let's get into a discussion here. What does the world look like today in terms of the economic landscape? If we zoom out all the way to the top, all the way 30,000-foot view, we have two opposing powers that are right now trying to gain control of money and of resources and global dominance. There's the US government, or just USA in general, and then there's China. Those two competing forces are kind of driving most of the economic activity in the world. So people are taking sides. Some people are starting to trade with certain countries they don't normally trade with. Certain assets are being traded in other currencies as opposed to the dollar, which is kind of hurting the dollar's dominance. There's other currencies coming up that are trying to compete with the dollar, making it harder for America to sort of conduct its foreign policy and to conduct its monetary policy and its trade policy. So big picture, we got China, we got US. And then there's all of these smaller kind of conflicts that are playing into this. We have the Russia-Ukraine crisis. We have Europe kind of going to shit right now. We have Asia trying to save itself from another major crash. Japan still very loose monetary policy, trying to incentivize growth. Africa doing a lot of business with China, just in terms of industrials, in terms of financial sector, and some of these other key components of the economy. So we're kind of segment the entire world into those big things. We kind of have the USA and China going head to head over global dominance. And then some folks are siding with China. China's going out and giving multi-billion-dollar, tens of billions of dollars worth of loans to governments in order to take control over shipping ports, to take control over airports, to take control over major business centers. And the strategic position that China's playing right now is kind of like that game Monopoly, where the more pieces you have on the board and the more strategic pieces you have, the more power you can have on the board. America's been the global superpower since World War II. And what the USA is trying to do is maintain its global dominance and maintain the dominance of the dollar. This is what it's all about. It's all about protecting the global dominance of the US dollar structure, because some of the biggest assets in the world are traded in dollars. Let's take oil, gold. I don't know why I'm skipping. There's a bunch of assets around the world that are strictly traded in dollars. So we have these two competing forces. And then there's things like Russia trying to become a competitive force. And then there's things like some of these smaller nations trying to do the same thing by teaming up together. So you have the Irans, you have the North Koreas, you have some of the problematic powers. So that's how I put the biggest issue. That's like the number one thing on the grid right now is US and China are beefing. There's a trade imbalance and we're going through it. What's happening in Europe? Let's talk about Europe real quick. And I'm going to use my trading view chart here just to illustrate some of these points. So European monetary policy is very loose, which means they're printing a bunch of the euro, making the euro worth less and less over time. And they're not creating enough policy to incentivize business growth. So in America, what makes the business sector so powerful is that the laws and the taxes and all this shit is all geared towards businesses. So for example, if you have a job right now and that's your only source of income, you're getting taxed at the marginal income rate. So at the low end, it's like 20%. At the high end, it's like 49%. Most of us getting taxed anywhere between 30 and 40%. And so you get taxed 40% of your income if you're working a job, just for working a job. Now, if you're an investor, for example, let's say you have a passive income investment like real estate, you pay capital gains tax, or you might pay corporate tax, or you might pay some other kind of passive income tax. And all of those taxes are significantly lower than the income tax. So the tax structure incentivizes people to go out there and start businesses, to go out there and become an investor, to go out there and create passive income investments, because that's obviously what whatever they write into the tax law, that's what they're trying to incentivize. So America has a very, strong business culture because the tax laws, the regulations, and everything else in between supports people going out there and being productive. In Europe, laws are a little bit different and they don't incentivize growth in the same way. So people aren't incentivized to go out there and create changes to boost their supply and demand, to create goods and export them, to hire people from outside the country, and all the other things that businesses do in an economy. So because of that, they have shitty ass policy. Their economy is going to shit. They're printing way too much of their money. Their interest rates are negative, which means they're paying central banks to take the money and go out there and incentivize growth. It's a stupid fucking model. So Europe going to shit. We can see the value of the euro is completely getting decimated. That's what we're going to continue to see, I believe, for the next 3 to 5 years, until they have to basically get off of the euro and go to a digital euro system, which is the future of currencies. In the next 5 years, we're going to see most major currencies shift over to a digital system or a digital representation of itself. That's kind of where we're at. So any questions on the big picture before we keep going? We kind of talked about the US-China relationship. That's kind of top of the hierarchy right now in terms of problems in the world. And then if we look at the Asian landscape, it's basically just Japan and Korea trying to maintain while having horrible monetary policy. We shift over to Europe, dumpster fire. Africa doing business with China. China's picking up all of the strategic seaports and shipping ports, airports, and things they need to conduct business. And America's out here trying to maintain its stronghold. Everybody understand that? Cool. All right. Let's go through recession watch. Are we in a recession or not? So based on the traditional definition, 2 consecutive quarters negative GDP growth. We've already had the first GDP number launch 3 weeks ago. The next GDP number releases in 3 days. Big thing to watch out for. On Thursday, 8:30 a.m. Eastern time, they're going to be releasing the advanced GDP number, which is a follow-up to the preliminary that dropped 3 weeks ago. So 2 consecutive quarters, yes, we're in a recession. But let's look at some of the main factors of an economy and let's see if we can decide for ourselves if we're in a recession or not. And I want you guys to tell me, based on the information I provide to you, whether we're in a recession. Like I said on the other streams, y'all, we can keep getting news from some of the mainstream news sources and keep getting told a narrative, which is just like a story that they want to tell in order to get more views or whatever the fuck they're doing. Or we can look at the data ourselves and make an informed opinion about what's happening in the world around us. And when you do that, you can kind of get ahead of the trends. And this is how you take advantage of trends. You kind of look at how the world is working. You're able to position yourself somewhere strategic, and then you're able to allow the world to sort of evolve around you into that thing. And you're able to make money just by being invested early. So that's kind of what we're going to go through and talk about. So 4 main factors when we look at the health of an economy. Number 1, GDP. Number 2, employment. And employment involves unemployment. It involves people who are filing for unemployment. It involves people quitting the workforce. It involves the number of open jobs, et cetera, et cetera. So GDP, which is the size of an economy, we have the employment rate. Let's see, the four biggest factors. I don't want to say interest rate. Doesn't really matter as much. Productivity is all incorporated in GDP. Say inflation, which is inflation represents a lot of things. There's asset inflation, which is, do the stuff that people own in that country, is it going up? So if you guys lived in a random country, that country, let's say they prioritize holding gold or cash. And so asset inflation for them would be, is that gold going up over time? For us, we have different types of assets that we hold in the United States. Obviously, you guys are watching from around the world. So it could be real estate, it could be stocks, bonds, it could be corporate treasuries, it could be physical, collectibles, or any other asset. Are those going up over time, or are they going down over time? If the whole country is holding, let's say, rubies, that's like the thing, that's like the culture. Everybody holds rubies and you pass them down from generation. If those things are going down in value generation over generation, then they have a very, very backwards inflation system in terms of their assets, in which everybody who's in the investment class is going to be losing money over time. Doesn't make any sense. Asset inflation in America means the majority of people's net worth is tied up in their home, which means that as long as home prices are going up, we have a positive direction in terms of asset inflation, because the assets that people hold, real estate, are going up over time. Right now, we have asset inflation in the car market, jewelry market, housing market, stock market. Well, not stock market. Stock market's let off a lot of steam. But there's different types of inflation. Wage inflation, are people's paychecks keeping up with the rise of goods and services or not? There's just consumer inflation, the price of goods and services at the store. There's everything in between. Those are the main factors that I look at. And then there has to be one more. There was one more big print that I would say, this fourth one is very dependent. The reason I'm having trouble figuring it out is because every country has a different metric that we're watching. In the US consumer is the most powerful force. And as long as the US consumer is buying things, corporate earnings are good, stocks go up, the country's healthy, there's more jobs, everything gets fixed if consumers are buying more. So in the US, over here, I would say retail sales. But for other countries, you would want to look at the savings rate versus the investment rate. For some other countries, you'd want to look at the inflation rate versus the cost of goods, versus the wage inflation. So this last one is just dependent on whatever country you're looking at. Let's look at the United States. We'll do GDP, employment, and inflation. So I'm on the St. Louis Fed website. This is a website that the Federal Reserve puts out to release all of their economic data. And they do this for the purpose of collaboration. Basically, they're trying to get as many smart people in the world to look at this data, to send them feedback, and they just want to be as transparent as possible. The numbers that they give out are based on Bureau of Labor Statistics and some of their internal analytics. Not 100%, to be trusted, but they're still a good guideline based on how the Fed is going to react, because they use this data as far as we know. So we can look at gross domestic product. This is the GDP, which is basically the size of the United States economy over time. Since 1950, we've consistently grown our GDP. Now you can see this thing is kind of like on an exponential curve. Since 2010, this is the 2008 financial crisis, where we started quantitative easing. We basically started playing in a new league because we introduced trillions of dollars into the economy that weren't there before, and we just increased the size of the game. That's what inflated a lot of problems that we have today, such as the wealth gap that's exacerbated in this entire time. We see the massive inflation that we have. We were running at around 8.5% inflation this year, which means the cost of goods and services is going up 8.5%. So all of that has been exacerbated by the amount of money that we've been pumping in the system since 2008. So this is a good guideline to track the health of the economy. So after 2008, we launched the TARP program. We tried to get ourselves out of the recessionary environment and out of a global depression. So we basically just started pumping money into the economy, and we kept doing that for 10 years. We stopped doing it in around 2018 and 2019. We tried to slow things down. We didn't get very far. And then 2020, we had the coronavirus crash, in which case there was an emergency response and we ended up pumping a record amount of money into the economy. So that's where we are today. 2020, we had that massive crash. We pumped a shit ton of money into the economy and everything has gone up in price because of the amount of money we pumped in. Trillions and trillions of dollars. All right. And it's just completely gone haywire. So we kind of see that the gross domestic production pre-pandemic was sitting at around 21 or 2.1 trillion. Hold on. I think this is measured in thousands or tens of thousands. Yeah, this is 21 trillion. So 21.7 trillion pre-pandemic. At the pandemic lows, we lost basically like $5 or $6 trillion in total GDP in the second quarter of 2020. And since then, we've gone to make new highs. The total GDP of the United States is sitting at around 25 trillion dollars, which is incredible. This is the annual GDP, if I'm not mistaken. So the amount of production that we have, the total economic activity in the span of 1 year is around $25 trillion. So this should continue to go up. It looks pretty healthy. GDP decline, I don't think this thing tracks quarter by quarter. Yeah, so I mean, if I'm being completely honest, from what I'm seeing here, we're still waiting for Q2 to print and Q3 to print. So I guess we're going to get an accurate representation. But it looks like Q1, we printed a $24 trillion GDP. And then Q2, we printed a $24.8 trillion. So we're still rising. I don't know what the news is talking about negative GDP. This might be the... Okay, here we go. So this is real GDP inflation adjusted. Okay, so when you adjust for inflation, this is what we're talking about when we say negative GDP growth. So we're on the real gross domestic product chart under the Fed economic data website, or the St. Louis Fed economic data website. We're seeing negative GDP growth quarter over quarter. And that's what's indicating a slowdown in total output. Now let's look at CPI. Sticky CPI is basically just, it sticks around. It's not just like transitory, things go up for a little bit and then they come back down. Certain things, let's say car prices get really inflated when the market is dry, but then they end up coming back down at some point. A more sticky inflation is like, let's say, rent prices. Rent prices are sticky because they don't tend to change them back down when inflation comes back. So if you guys have ever seen your rent come down, that's a miracle. Very rare for that to happen. It does happen occasionally, but those things don't get adjusted back. They just stay high. So sticky inflation versus regular inflation. Let's look at the sticky inflation here. And this is minus food and energy. So minus cost of food and gas. So since July of 2021, we've seen inflation just start to go up and up and up and up and up. Trying to see why won't it go further. So it's not going to print the annual data, I guess, until the year is done. But you guys can see July or January 2020, this is when we had the pandemic. And so because demand slowed down, no one buys anything. The only way corporations can stay open is by lowering their costs. So there was a drop in inflation, which was really good. But because of the amount of trillions that we pumped into the economy, that's when the price of everything started to go crazy. The problem that we had is around October, well, probably around the summer of 2021, inflation was already right back up. And so this is when the Fed probably should have taken their foot off the gas and stopped pumping so much money. But they continued to pump the money all the way through 2021. And we ended up seeing inflation hit almost 5% at the end of the year. Now going into this year, I think we're expecting an 8.5% inflation number. But yeah, real inflation sitting around 5.6. This is total items in the United States. Just everything is going up. This is like all consumer prices. So we kind of had to look at those main elements. GDP since the pandemic went like this. So it's 2020. We printed a bunch of money. Oh, sorry. We printed a bunch of money, and then in 2021, we saw inflation go up, and then we started crashing. This is 2022. So GDP has been declining. Employment, we're going to look at that in a little bit, but basically it's the same trend. Actually, employment's holding pretty healthy. We had a massive spike in unemployment, and then right now we're back at record lows, around 3.5% unemployment. And then inflation was sitting steady. Then the pandemic hit. Then we pumped a whole bunch of money. And then inflation has just run rampant. All right. And we have to bring inflation all the way back down here. That's kind of the overall framework that we're looking at. Unemployment, if we look at the market, still pretty healthy. There's still around 10 million open jobs in the economy, with only about 5.5 million unemployed people. So if the unemployment number doubles, if we go from 3.5% up to 7%, which is horrible, absolutely horrible. Not that the full 10 million jobs can be occupied by the number of unemployed people, because the skill sets don't exactly match all the time. It's not like a bunch of people get fired at grocery stores and then they can become coders. I understand that's not how it works, but the fact that we have so many open jobs provides a pretty good safety net in case the unemployment rate does go up. So that's kind of something that I watch, just in terms of how healthy is the employment kind of picture in America, and how big of a safety net do we have in the back end. Now, the problem is that a lot more people are applying for unemployment benefits, which creates liabilities on the government. The government has to pay for those, which is not good, because it puts more strain on the government, meaning taxes will eventually have to go up. So employment holding strong. We have a good number of unemployed people, or we have a pretty healthy number of unemployment. We have a good number of open jobs, and things look to be moving in the right direction. Inflation is still running higher than ever. We did have a CPI print come out last week that was very stable, which was basically we had no inflation growth for the first month all year. So prices didn't go up for a whole month. Thank God, right? So we're going to start to see how those monthly numbers come out. And if we start to head in the other direction, prices start to come down, things are more relaxed, people are buying less stuff because it's the summer. Okay, we're done with the summer travels, we're done with buying new things, and we start to see prices come back down. That's going to be a great direction for us to head to. As for now, the inflation problem is still getting worse. And then GDP is declining. Obviously, we have that print later this week on Thursday to confirm, but it looks like we're headed in the wrong direction in GDP. So let's sum up this story. Growth is declining. All right. So people creating stuff, buying stuff, hiring people, spending money, everything in between, that's declining. Prices still going up. And then employment, it's holding flat, but it's doing pretty good. Let's put a giant check mark here. So those are the three main things I'm looking at in terms of the economy and how I gauge whether we're in a recession or not. Is the country growing or not? Just overall, right? If they're incentivizing people to go start businesses, okay. If they wanted to incentivize any of these factors, you could do them through either regulatory response or you could do them through monetary policy. Mostly it's legislation. So they have to pass a law to, get people to start moving. How do you do that? You can influence all these different factors, but here's the problem that legislators and central bankers have. If you want to influence this one, you're going to fuck with this one. And if you want to influence prices, you're going to fuck with employment. And so it's a giant balance of how to get this one to move without fucking this one up. That's exactly what got us in this mess. The government printed a lot of money to try to incentivize growth. By doing that, they made the prices go through the roof. So right now, if we want to get growth to go up, and we want prices to go down, and we want to keep employment flat, that's going to be very, very hard to do. So that's kind of the dilemma that everybody's under right now. Every country is kind of having this problem. To incentivize growth, for example, they can print money. But if you print money, prices go up. Okay. So let's say you want prices to come down. Well, you're going to have to get people to stop buying stuff. Well, if you get people to stop buying stuff, growth slows down. Right? So do you guys see the dilemma that most countries have today? And so that's why it's not an easy question to be like, why don't they just fix this shit? Why don't they get prices down and fucking get people to move? Not that this would ever happen, because I'm not stupid enough to ever run. But if I was president, here's what I would do. Basically, I would get Congress to pass laws to incentivize growth. How do you do that? Is you reduce the corporate tax rate, not raise it. Right now, Joe Biden in the Inflation Reduction Act just raised the minimum corporate tax rate to 15%. So before it was 10%, which means that you guys could all start a business. You guys as traders, you could start a business. And if you're not making that much money trading, you only have to pay 10% corporate tax rate on your trading profits. So you can register yourself as an LLC, and then your LLC is making money as a trader, and you only have to pay 10% taxes versus the 30% that the government was going to charge you as income. So it was kind of a workaround. Now they just bumped up the 10% up to 15%. So now it's like, if you want to go start a small business, you're going to have to pay so much in taxes. That could be the make or break of whether you make profits or not. All right. So this is like a slight thing. So what I would do is I would reduce the amount of taxes on businesses so that they have more profits. They go out there and hire more people. They invest more into the economy and things start to move. I would also incentivize certain jobs. So if I see certain sectors that are a big danger to the economy, I would incentivize that sector with either, a reduction in taxes or some sort of subsidy in order to hire more people. So let's say we're about to lose a bunch of people in retail. Walmart about to fire a bunch of people, and retailers are about to start cutting people, which we're already seeing. I just had my team send me a report. Let me show you guys this. Ford cuts 3,000 jobs to lower costs. Home Depot just cut a bunch of jobs. There are all these layoffs happening as it is. So you'll start to see like, okay, we don't want retailers to lay people off. We will give them a tax break in order to retain their employees, and then we'll incentivize them to spend money somewhere else or save money somewhere else, right? So let's say that like you can either fire a bunch of your people or you can miss your quarterly targets. You can either fire a bunch of people or you can invest less in research and development. So we'll give them a tax break in order to get them to keep everybody on board. And then we'll give them sort of like a penalty for spending too much in some other areas. So it kind of fucks up their business flow, but at the same time, you can save the economy and you can create legislative structures to incentivize growth. On the prices side, I think that we're doing a good job in reducing demand, but I think that the government trying not to panic people is actually making this problem worse. They're saying we're not in a recession. There's no need to panic. Well, what people think is, okay, well, fuck, we're not in a recession. Keep buying stocks, keep fucking going on vacation, keep paying for that extra thing, put that thing on layaway, fucking do this and that. And so people are still spending. If the government actually wanted prices to come down, they would remind people, hey, we're teetering on the edge of a recession here. Everybody should be smarter with their money. What happens is people spend less. When people spend less, prices come back down, right? So businesses are still hiring. They're still incentivized to keep things moving, and they're still kind of reducing their costs in order to meet the demand moving. And prices can still come down because, well, fucking demand is down. There's only one way to get you to buy a car right now, and it's if these manufacturers reduce the price of cars. No one's going to buy a house today at these prices. So if you want people to buy houses, you have to lower the price. That is the masterful mix and art of GDP, employment, and inflation, and how they play into an economy. Let me see if you guys have any questions. I can answer some of these questions for you guys. Let me know. Brief word from our sponsors. This stream is sponsored by Enigma, the #1 FX signals app in the world. So if you guys are a Forex trader, you guys want access to quality signals, high-rated results, and full transparency, this is going to be the place for you. We've been an almost 90% win rate since we started, and that's not many people can say that. All right. So start your 30-day free trial. Go ahead and check it out. Let us know what you guys think. EnigmaFX.app is how you guys can reach that site. So go ahead and check them out. Let me know if you guys have any questions about the things that we discussed, and we can go through some of those. Does it matter who speaks from the Fed? For example, Powell speaking Friday. Does the market move according to what he says? Yes. All of the other speakers, it's good, but it's mostly for us analysts. And so if let's say the Philly Fed speaker or the St. Louis Fed speaker is talking at some college somewhere, it doesn't fucking matter to the big picture. What matters is if he slips up and he says something important. He's like, oh yeah, at the last meeting, we all agreed that we were going to raise basis point. We were going to raise it by 75 basis points, but me and 4 other people disagreed. That shows that there's tension inside of the Fed, that they're not all on the same page. And so it's a little bit deeper than just superficial who's speaking and what is being said. All right. So much value for the webinar. Bless you. Guys, that's why we're here. Right? You could pay a shit ton of money to learn this stuff in school, and they're not going to teach you this stuff effectively. What they're going to do is they're going to teach you the efficient market hypothesis, which shows you that supply and demand work on an efficient curve, where basically as supply goes up, as demand goes up for something and supply goes down, you get a rise in prices. Right? So they're going to teach you the efficient market hypothesis, which doesn't really work in the real world. Really, what works in the real world is this flow. I want you guys to learn this. It's probably the most sauce I've given you guys all call. There's one thing you guys take away. This is the flow of how things work. There are real things that happen in the world. This is supposed to be a globe. Bear with me here. There are real things about what happened in the world. Then that translates to a narrative. A narrative is a story that the majority of people are telling about a specific thing. The narrative is like, the Fed is going to keep tightening, so stocks are going to keep going down. That's a story. It's a narrative. The narrative leads to sentiment. That sentiment is basically how the market feels about the story, whether everybody's on the same page, whether it's divided 50-50, whether, everybody's kind of fearful or they're very, very, basically we can just split this up into like, you're either, well, I guess there's 3 categories. We'll talk about sentiment later. Sentiment is how people feel about the story. And then after sentiment, there's action. And then the action causes price movements. And sometimes these happen in different orders. Sometimes there's a narrative that comes out that drives the real world event. And then that real world event creates the sentiment. So sometimes these 3 are interchangeable, but most of the time, let's say it's the pandemic. The pandemic happens. There's a narrative. The narrative is the world's going to shit. Everyone's dying. Then there's a sentiment. The sentiment is sell everything, get into cash. I don't know what's going to happen, but cash. And then there's an action where everybody sells off all their stocks, their assets. They close out options contracts. Supply demand goes to 0. And then we see the prices all crash on the stock market. So real world event, GDP number comes out negative. The narrative is, if it's negative, that means the Fed sees the Fed can't go as aggressive. Wait a second. If there's negative GDP news this Thursday, then the narrative is going to be that the Fed has to do some kind of action in order to create a reaction. So that means that if it's negative, then we're going to expect the Fed to stop tapering, which means that stocks and everything should go up. By stocks crashing, I think that we're anticipating the GDP number coming out positive. If the GDP number comes out positive, even though that's good for the economy, what it signals to the Federal Reserve is that they can continue to raise rates and they can continue to take money out of the economy because they have a healthy economy behind them. And as long as the economy is healthy, they can keep pushing these buttons and they can keep sort of trying to get prices down. So a positive GDP number would actually cause the Fed to continue its tapering, which would mean that stock markets would crash and the dollar would go up. So I think that the market is actually signaling a positive GDP number now that I kind of stack it up like this. This is, you guys are seeing the thought process live. So that real world action, let's say that we have a positive GDP number, which means the narrative is that the Fed is going to continue to tighten. The sentiment is now risk on, or sorry, risk off, because the Fed tightening makes people not want to buy stocks. And a risk off sentiment makes people buy less stocks and sell stocks and crypto. And that's where we're going to see stocks crashing and cryptos crashing. So let's go ahead and verify that narrative. Dollar is indeed chugging. So since the 11th of August, which is basically 10 days, we've undone all of the negative price action movement over the last month. So 10 days ate up all of the negative price action movement. The dollar is back bullish. Stock market back bearish. The world is back in equilibrium. US 30, the Dow Jones back bearish. Bitcoin back bearish. So we're still in this channel, but this massive bearish push from the daily, what is this, the 19th? I want to say it's a Saturday. Huge signal to me. Okay, it's a huge signal to me that I think that we have a lot of bearish momentum and we can continue to the downside. So for me, I expect crypto to continue crashing, but we're going to have to, obviously wait and see. We've engulfed all the price action since early July. So everything that we've done since July has already been eaten up. And I don't know, I have a feeling that we're going to crash through the June lows and continue on this bearish momentum. So that is the fundamental forecast. It's kind of what we have in the global economy. We talked about three very important things. The big picture: China, US going head to head over the global order. Russia, Ukraine throwing a wrench. Saudi Arabia throwing a wrench in that conflict. We have some of these other smaller nations playing along. Japan crashing. Euro dumpster fire. Africa on the come up, but most of their assets will be owned by China. United States losing global dominance. That's the big picture. Recession watch. We saw that GDP, which is the growth of the economy, is still positive. Or sorry, it was negative the past 2 quarters. Post kind of the pandemic, we had a massive spike because there was a lot of money being printed. Things went back to quote unquote normal. And then since then, we've started to see a massive decline in GDP off of those highs. We're also seeing inflation continue to go up, which means that prices are still rising. The unemployment situation and the employment landscape is still healthy as far as we can tell. That is the total macro picture. That's the total news picture. Keep an eye out for that news on Thursday for the GDP print from the Fed. And yeah, that's the overall news landscape. Recession can't be in full effect if they've warned the public and retail about it happening. We will revisit the highs at the last most, likely create new highs, and then we'll see what happens. I don't know. It's a little bit less likely. Would love to hear your thoughts on oil fundamentally. We're still crashing because we've done a bunch of backdoor deals that will allow us to basically bring the price of oil down. Basically the Biden administration went and did an apology tour in Saudi Arabia, said, look, we fucked up. We're sorry that we, waved our finger at you for killing our journalists and for doing things around the world that you shouldn't be. We really need your oil because our people are unhappy. Can you give us more oil? And we sort of opened that door back up. OPEC had a meeting to basically agree on increasing the amount of supply in the market. And the Biden administration dug into our strategic petroleum reserves, which are our wartime reserves for oil. So we dug into those, released a bunch into the market, and the price per barrel has come down. And so the price of oil has come down. You can see the national average has also made a giant dip. So you say national average gas price. Shout out to AAA. You can see the national average is 3.9, down from the $5 lows back in June. So if you guys look at this website, this is the gasprices.AAA. AAA is a company for towing, automotive. I don't really know what they all do. They're kind of like an insurance company. You can see in red are the most expensive states. So West Coast getting hit the hardest in terms of gas prices. If you live in the Southeast America, you're getting the better end, the sweeter end of the deal. So anywhere between 3.5 to 3.4 in Texas, all the way down to Georgia. If you guys can see some of the more expensive prices on the East Coast or Northeast. So if you're in Maine, New York, any of those areas, you're getting hit pretty hard. Yeah, I don't know why West Coast is getting hit so hard. It's probably because of the transportation of oil. We have there's a few pipelines, I think, on the East Coast that make it easy to transport oil around, but West Coast might not have that. Bada boom, bada bang. If we looked at this over the past few months, which I don't know if they have a graph here. So mid-grade is at 4.3, premium is at 4.6, diesel is at 4.9. So if you guys are looking at the gas prices, you'll have seen this regular was at 5. I think premium got all the way up to 6.5 or 7. It was crazy. The highest recorded average price was in June. All right, so for diesel, it was 5.8. And for regular, it was 5. Insanity. Regular gas hit $5 national average. People were losing money going to work. You could go out there and fill your truck. By the time you got to work, you lost more money than you were going to make at the site. It was fucking incredible. This is liberal taxes. Hey. If I'll be honest, we're going to have to split this. New York, extremely liberal, but it's also just densely populated. California, same thing, extremely liberal, but also densely populated. So that might be a factor. It's kind of hard to tell whether it's the liberal policy or the dense population. But then you have Oregon, Idaho, and Washington, not very densely populated, very liberal, also high gas prices. New Mexico, Texas, Oklahoma, Arkansas, low gas prices. Well, shit, might be onto something. Looks like a correlation to me. All right, please elaborate on trading as an LLC to reduce taxes. I'm not a licensed tax professional, so you're going to have to go talk to somebody qualified about that. Does that mean minor bullish momentum on silver USD and gold USD? No, bearish momentum. You guys can see if the dollar is rising aggressively, and if Bitcoin is crashing and stocks are crashing and some of those high risk assets are crashing, you're going to see people basically get out of assets and get into cash because they feel like, okay, we've had a massive pump since June. Now is probably getting close to the highs of this whole like relief rally. Let's get back into cash and let's see if we can dump that cash in once we crash again. This is my thesis. Obviously, I could be proven wrong if the market just continues to chug bullish, but I do believe that that we're going to start to see a lot of profit taking here from the June lows. A lot of institutions that bought cryptos at the lows in June are going to take profits. Who bought stocks in the June lows are going to start to take some profits, and we'll see if those if that profit taking affects the market. All right, everybody. That was another Forex forecast, FX forecast. Keep an eye out on these streams. We'll do these every single Monday. The recording will be posted right after this. Every single Thursday, we stream live to show you guys how we trade. I call out trades live, so hope to see you guys on that one. Again, the stream is sponsored by Enigma. It's the #1 Forex signals app, posting an over 90% win rate. Past profits don't equal future results, but we are posting a 90% win rate since we've launched. Not many people can say that. Fully transparent results and quality signals only. You guys can sign up for a 30-day trial going to enigmafx.app. Hope to see you guys there. And if you guys want any help in your trading, head over to chartaddictsfx.com and start personal coaching today. See you guys on the stream. Take it easy. Peace.